Two big names in the investing world on Fox Business today talking about a potential market correction, but not the first time these two giants have tried to warn the world.
You do.
I
know you do, but it sounds like
I am very hedged, and I would say that I think you have to worry about it.
It sounds like you're saying this could be the beginning of something problematic.
I say that it's just not a question of could be the beginning. I think it's not will it happen. It's when it will happen.
I think the U.S. economy is still growing below potential, though, Trish. 1.5% perhaps over a 12-month basis versus a brand new structural average of perhaps 2% or so a little bit less than potential.
All right, but, Carl Icahn, he's been warning this kind of stuff for a long time. In fact, he said there could be a downturn back in March 11th. Of 2011. Of course, the S&P since then, it was 1304. It's up 62%. And Bill Gross, I think you might remember his infamous prediction about the death of the cult of equities. Well, that was back in July of 2012. The S&P up 54% since then. Now, today, I got to tell you something. This market had an excuse to sell off. You saw this morning, we did end up okay, but we were up early, a strong rally. It all faded all the way. We were losing money, and then all of a sudden, buyers stepped up. So what's an investor to do? Sell it all? Stay away, or maybe just go into cash when Carl Icahn goes into cash. All right, guys, it's a Monday morning, and all the doom and gloom guys are out. They get out every day, I guess. Hey, I'm Charles Payne, and you're making money. You're watching Making Money. Let's introduce the investment pros. Jim Frischling is with us. President of New Oak Capital, Scotty Nell Hughes is the Cpayne.com news director. Hillary Kramer, President and Chief Investment Officer at A&G Capital. And my man Jim Awad, it's been too long. He's Managing Director of Plimsoll Mark Capital. Good to have everyone. Let's do it, guys. Let's dig into the first real deal. All right, guys. Carl Icahn, Bill Gross. What is it about these guys, Jim, that they're in the market? And I just looked at Carl Icahn, Icahn Enterprises. He's bragging about how much money he's made in the last 5 years, in the last 3 years. But if people watching, a regular investor watching him on TV, sees what he's saying, they miss those gains.
Well, I think it's two things. First of all, that they are opportunistic. Both Bill Gross and Carl Icahn are opportunistic, and when they see something of value, they buy it, no matter what. But also, if you've been in the business a long time and you see this kind of run, and you've seen various corrections over the past, you do have a bit of skepticism. So it's not...
But going back to 2011, I can see if someone said this today. But if you say it over and over again, and at the same time, by the way, you are investing and you are bragging about your returns, I don't get the...
Well, I think what they're saying to people is have your guard up. We've come pretty far. A correction could come anytime. But if you see opportunity, go for it.
Is that what you heard, Scotty?
That's not what I heard. I mean, it's not hard to sit there and say that we're going to have a correction soon, that we're going to have an adjustment. I mean, it's kind of like saying it's going to snow in Boston next winter. That's just a given. My question is, what is their motivation for doing this? If we're sitting here and we're trying to create this environment of positivity moving forward in the market, and they're saying it's going to collapse, you know there's nothing about being benevolent on Wall Street.
I'm going to ask Hillary because Jim is blocking for these guys right now. All these billionaires block for each other.
Okay. My answer is that Bill Gross, Carl Icahn, and most of them underestimated and didn't understand and didn't look academically to understand the importance of the Fed and the power of the Fed to increase asset bubbles, and that would be the stock market.
Well, there's no question Bill Gross had his issues. That's why he made it, a couple of years ago, if you said Bill Gross would be leaving his firm, no one could have imagined that in a million years, and some of the performances that he endured over the last couple of years. So he's had some miscalculations, but Carl Icahn, Jim, has been in the market, and he's been pounding management. Now, granted, he looks for value. I know he recently picked up some Chesapeake and things like that. So he is looking for what he thinks are undervalued stocks, but he is in the market. And even, by the way, if we have the crash he's talking about, those undervalued stocks go down, too.
Look, I mean, these are two gentlemen, Icahn and Gross, that are really in a unique class. We're not in the beginning of a bull run. I think everyone on the panel would agree with that. Question is how far into this run are we? And I think to a certain extent, it's safe for them to make that call, because if they're wrong or they're wrong by a little while, they're not giving up that much upside for them. They're not impacting their life. So, again, I think they're in a unique group that can actually even talk about pulling off, whereas I think we may have a couple years left of this, or at least a year or so. And I think for the average investor, pulling out too soon might impact their life. Taking money off the table might be a little too quick. So again, these guys are in a unique class, and their conservatism to a certain extent, they can play that way. They can talk about it.
Wall Street shouldn't let these Wall Street and these power players, they're really bullying the individual investor into thinking, I better not go into the market. Oh, I'm never going to make it.
Why would they do that? Either way, I mean, if I've got the kind of cash these guys have, granted, I would do a television interview
I think
from
it's
time to
because
time.
but my point is they really do believe that the market was not going to go up. They really don't get it.
But if you look at this, Carl Icahn himself, he's into Apple. He just put $100 million, I think, into Lyft. I mean, he's into these safe stocks. So his idea is to sit there and make things seem like it's really volatile to encourage people, go into these safe stocks that I've already put money into.
I don't think they realize the impact they're having on the average viewer. That I think they're talking very cerebrally, intellectually. The market's up. It could have a correction. They don't realize how much they're spooking the average investor. So I would say to the average investor, ignore it. Ignore people's forecasts on the stock market.
I tell you, to your point, though, there are people who have less influence because they're so much less accomplished than these guys. But they do write books, they do write blogs, and they hijack these sort of comments and put them in their blogs and put them in their books or promote their books. So someone says, hey, Icahn's calling for a crash. Buy my book, go to cash, and buy some gold coins while you're at it.
You might be right, but what the average investor has to realize is wealth is created through the ownership of equities, through the ownership of companies, and notwithstanding corrections and the professorial assumptions of people rich and not so rich, that you got to own them over the long term.
Do you get anxious like this from time to time?
I get anxious all the time because I have seen so many bear markets, devastating bear markets, all the time. And what that's resulted in screaming good markets. My clients don't do as well as some of the young, hot money managers. But when things are tough, they protect it. And my clients are comfortable with that. But
I would
not all
suspect your clients,
would
though, your clients are trying to preserve wealth as opposed to necessarily gaining wealth or creating wealth, which does mean different risk.
Right, absolutely. They don't want to. They want to participate when things are good and not get killed when things are bad. And they don't care if they're not in the top of a rising bull market, which is different than some young aggressive people.
So let's just say the correction is coming right around the corner. Maybe the jobs number comes out Friday and it's whatever the trigger is. Let's talk about a stock that someone would own even through a crash. What would that be, Hillary?
Procter & Gamble, PG. You still have your 3% dividend yield, so even if rates go up, believe me, you still want 3% from P&G. P&G is global, international. If the euro starts to strengthen, then P&G is going to benefit from the foreign currency translation, and we all need Pampers and
Are they doing more business now outside of America than here?
Yes, more than 50%.
So that's why, a strong euro helps them out.
It makes sense.
What's this stock? Okay, you know what? Hell in a handbasket. It's finally come here, and all of these guys and gals who've been predicting it for 6 years can take their victory lap. What's the one sort of stock in our portfolio that'll make it feel a little bit better?
Sure, different sector, but same principle of finding companies with great fundamentals. American Express, over the last 5 years, their revenues are up over 30%. Their net income up over 80%. They continue to be very shareholder focused.
Didn't they lose a Target deal? Were you worried about that a little bit?
Costco?
You just was it Costco? Costco, yeah.
Yeah, but I actually continue to see, first of all, the usage of credit cards, even as we move to Apple Pay or Google Pay. Fact is, it is a staple, very well run. And again, dividends are increasing, share buybacks, but even in hell in a handbasket, there's a company that continues.
In another area, people may consider utilities as well. Hey.